Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and today we have a very special guest on the show in episode 25, Passive Real Estate Investing Miniseries, Multifamily Syndications featuring O-Dawg. Before we bring O-Dawg onto the show, a couple of quick announcements I wanted to get started with. First, I want to give a very special shout out to Lithuania. We now have a new country in Lithuania that are listening to the show, and actually we just released, just this morning, and we're recording this episode here this afternoon, on Passive Real Estate Investing Miniseries, Syndications and Funds. They just tuned in to the most recent episode. Brand new listeners out there. Really, really appreciate it. Also, if you have any real estate related questions that you would like to email to the show before we wrap up the Passive Real Estate Investing miniseries, please do so as soon as possible, and we'll try to compile a Q&A if needed. You can send those to realtalkpersonalfinance@gmail.com. Again, that's realtalkpersonalfinance@gmail.com. And as always, if you feel like we've earned it, and you would be so kind, feel free to leave a 5-star rating or review for the show. Those are always appreciated. So without further ado, please help me welcome to the show, O-Dawg.
Thank you. Thanks, Cash Flow King. Glad to be here this afternoon.
Thank you for coming on to the show. We're going to talk some multifamily syndications today. Really excited about it. Hopefully everybody has already checked out the first couple of shows of the Passive Real Estate Investing mini-series, especially the most recent one on syndications and funds. As a primer, if you haven't checked it out, you may want to check it out before today's show, although we will go over some of that information again here today. So let's get started. Let's talk a little bit about, tell the listeners about yourself, who you are, what you do, and your journey into the syndication space.
All right. Well, first off, a little about myself. My wife and I have 4 children. We were a single income family with 4 kids, and we traveled around the country on different work assignments. So needless to say, we had money was always tight with us. But after our kids got a little bit bigger and took off to college, we started investing in different investments, and I did pretty good. Ended up having grandchildren and decided to retire after 43 years to enjoy the grandkids. So while I was in retirement, I have motorcycles and I do genealogy and a couple other things. I just was looking for something else to do, and I always enjoyed investing in the stock market or investing in general, and so I started going after the stock market. During the COVID crash, I was talking with some investors about investing, and we were doing okay on the COVID crash, but one of the investors told me about real estate syndications, and the more I talked to him on it, the more interested I got, and so I started researching that information, and voila, I'm here 2 years later. One of the first things I came across was the Bigger Pockets community. I started to research this. I started checking out the Bigger Pockets. I stalked on there. I didn't actually participate that much, but I read everything I could find on syndications in there to find out as much as I could and get as much information as I could. I learned a lot, and I got a lot of different perspectives from different people on that. But most of that was geared towards single-family rentals, so it didn't get me as far as I wanted. I then came across a book somebody recommended to me, and it was a real good book. I liked it a lot. I dog-eared the piss out of that book, and I decided I had my own copy. But it was a book on syndications, and it took you through the different elements of syndications and what to look for, what to be aware of, make sure you know this, make sure you know that. And it was great. I was able to use that book to, one, feel comfortable that I was at least aware of what goes on in the syndication world. And 2, it gave me a basis. I put a spreadsheet together so that I knew what I could ask individual syndicators or look at their paperwork and glean out of it how it was structured, how it went together, if there was any gotchas in there or anything like that. And I was able to help me put together a spreadsheet so that I was able to evaluate these syndications and determine which ones I wanted to get into.
All right, real quick, before we continue, for the listeners, anybody that's not aware, I don't think we've mentioned this on the show yet or not, but Bigger Pockets is, the way I like to think about it, is pretty much a blend between a Facebook and LinkedIn for real estate investors. So if you haven't checked out the website, feel free to do that. We don't have any affiliation with them. We can, although I didn't plan on doing this initially, but I am going to have a little fun with this, I think. I don't know if I can do this for Costco or not, but we're going to try. If anybody wants a link to purchase that book, the show might make a couple of pennies. We can send you an affiliate link. It's not going to cost you any more to buy it. First person that does so, you'll have your choice. So you can tell me in the subject line, chicken bake or pizza, and we will send you an e-gift card to Costco to get yourself a chicken bake if you so choose, or pizza of your choosing. We'll also include the affiliate link if you want to click through and purchase that book that O-Dawg's referring to. I have it myself. It is fantastic. So we are going to dangle that carrot out in front of you today. That's our quote-unquote compensation for doing the show. We might make 50 cents or something. I don't know. Anyway, all right. So that's Bigger Pockets. That's a little bit about the book. Please continue.
Well, anyway, like I said, then I started contacting the different syndicators and trying to build relationships with them, because you just can't sign up and go. Okay, you got to have a relationship with them. They're not allowed to advertise. You got to seek them out. So I started seeking these guys out and getting the paperwork from them and building relationships and putting them in on my spreadsheet and trying to determine which ones I wanted to go with and how I wanted to go. So I don't know any other way to explain it to you except for the spreadsheet told me where I should head and who I should make my agreements with, and it helped me rank people in order of preference. So
walk
I
us
got
through.
into syndication.
Can I ask? Sorry to keep interrupting, but I think this would be good for the listeners. So let's try to paint the picture for them for a second. Let's say I'm a syndicator and you somehow seek me out and you decide you're interested in any of our potential offerings. You want to talk to us. You want to build a relationship. What is a phone call like that? Assuming it's a phone call or whatever, what does that look like? How long does it go? What are you asking them? What are they telling you? Can you talk a little bit about any of your interactions with them?
Yeah, I can. I can tell you, I talk personally. They usually have an investor relations team, all of them, or the owner of the syndication or the manager of the syndication, and you talk direct to him. But these are people you talk to find out what they're doing. You try to feel them out for what their goals are, what their philosophies are, how they're going about it. I didn't let it get too mechanical. I wanted to know more about them, because the one thing I did learn in reading the book is that you are partnering with these people. This is a legitimate contract. I'm in an LLC. I'm a participant in an LLC on each one of these syndications. So I'm lending them not only my money, but my name, although it doesn't have a whole lot of liability associated with it, at least in the ones that I'm in. I still feel responsible to know who I'm giving my money to, making sure I know that this person's going to work for me and give me the most he can give. To me, it's no different than a stockbroker. You're hiring somebody or you're giving somebody your money to make you money, and you got to trust them. Because there's going to be good times and there's going to be bad. So you got to trust them so that whenever the bad times come, you know where you stand with them, and you know they're either in there for you or they're not for you. And I only invest with people I feel are for me and that I've developed a relationship with, that I can trust with my money.
So how do you get into that on a phone call? Like what are you talking about? What are you asking them? Are they asking you certain questions that are like, you know what, this company seems like they're trustworthy, or this individual seems like they're trustworthy, or no, these people are crap?
Well, again, it's all personal. I do it by talking with them, discussing my personal situation with them. That's something that they always seem to be willing to talk about. So they learn about me. I learn a lot about them on the personal level. And then we take it to the business level. We start talking the different elements of it, of the investment opportunity that we're discussing, and going back and forth, and you you want to understand, all right, this is a value add. How are you going to add value? And they take you through it. And then you just throw them the questions. Well, what are you going to do with the people you make mad? How are you going to handle that? And you just develop their answers tell you if that's who you want to invest with or not. Okay. They can be very mechanical and say, well, we just rotate the numbers, and they don't really give a crap about how they rotate. Or they can say, hey, listen, we work with the people. We make sure they know what's coming. Yes, there's going to be some that aren't going to stay with us after we upgrade the apartment buildings, but, the vast majority of them are. So you get that feeling. You start working that relationship with them, at least on the value add portions. The Class A apartments where there's very little value added, they're planning on just improving the functions of the operating system. They're bringing in a new operating company which is leaner and meaner. They're going to optimize a few things, and they're not really going to change the way the operation is, they're not looking to turn over the existing tenants. So you have a couple different ways you go through. Each one of these is totally different, okay? Whenever you get into the fund type LLCs where this syndicator is going to go buy, in one case we've bought 6 housing complexes or multifamily complexes, has over 1,000 doors in it between all 6 of them. Some of them are, B minus and they're trying to take them to B plus or A minus, and some of them are B plus already and they're taking them to A. So you get a mixture of what's going on with them. So it gets real complicated. I kind of like that because there is no one size fits all, and it keeps you sharp and on your toes and makes you talk with these syndicators so that you understand how they're going to do it, how they're going to represent you, and how you're either helping or hurting.
So when you talk about pissing the people off, you're talking about not the other passive investors if things go badly, or maybe you are, or are you talking, it sounded almost like the tenants that live there. So if I'm living in a property that they are trying to do a value add turnaround and they want to renovate my unit and my lease comes up for renewal and they basically say, hey, pound sand versus, hey, we have another unit for you in the other building that's already been renovated. Is that kind of what you're talking about?
That's exactly what I'm talking about. Are they trying to take care of the people that are there, or is it just money?
Yeah. And, just a quick aside, I know we did a couple episodes ago, I did an episode on turnkey rentals. And it's funny because I work with a couple different property management companies, and I talked about that in the episode. And one of them in our communications will almost always use the word resident. And the other one will almost always use the word tenant. And technically, they're referring to the same individual or the same family. But the ones that say resident have a tendency, good or bad, to be a little bit more lenient and be willing to work with the individuals that live there, versus the company that says tenants. Well, their lease is like 9 pages, and it's pretty like, here's how this is going to go, and if you don't like it, tough shit. Versus the former property management company, I think their lease is 1 or 2 pages, initial a couple places, sign at the bottom, and we'll work this out. So I think I can draw some parallels between what that looks like on the property management side for the single families, and it sounds like in talking with these syndicators, how they might refer, not necessarily by how they refer to the tenants or the residents, but more so what their action plan is and how they talk about and describe it can give you some insight as to how they're going to treat people and ultimately how they're going to treat you as their partner, as a limited partner investor.
That's exactly right. So that's some of the things I do. Another thing I do is a lot of these syndicators say they have $100,000 minimum or a $50,000 minimum or a $20,000 minimum. Depending on the syndication, I'd like to challenge that and see if they're willing to work with me as a limited partner. Are they willing to work with me? So, if it's $100,000, I may say, hey, I'll go in for $25,000. And some of them will say, hey, listen, we're trying to limit it to a certain number of people, so we're not accepting offers that low. And others say, hey, listen, we understand you're just getting into it, and we're willing to work with you, and we'll take the $25,000 on this first one as long as you agree to move up on the next ones. And different answers for different syndicators, but all at the same. I've went with syndicators that won't negotiate with me because they're trying to limit the amount of partners that they have to deal with on it, and I've also went with some that have been willing to deal with me.
Yeah, that was going to be my next question. Depending on their response, is it like, hey, if they take the lower amount, are they desperate for cash? And versus if they say no, we're going to stick to our guns. Are they more disciplined in their approach? And it sounds like it's kind of a 6 of one, a half a dozen of the other. Just depends.
Each syndicator is different, and that's something you got to have a feel for. You can't put that on a spreadsheet. That's just you reading the person you're talking to when you're talking to them.
Yeah, no, I agree with that 100%. And there's some little things and some cheesy things that some of these groups do, just thinking about some of the deals that I've gone into recently. And there's one in particular, there's one group that they are, from a cost and fee standpoint, probably a little on the higher side. From a projected return standpoint, probably a little bit on the lower side. And I put a little chunk of change with them. And to be honest, I'm considering at some point, probably in the next, 6 months or so, 6 to 9 months, putting some more money to work. And they're one of the first groups that comes to mind, not because of we're going to knock it out of the park with returns, although returns are still important, but because of the relationship aspect. Like there was one group who literally would record, like one of the top guys at the firm would record a video response. Like you would ask a question and he'd send you a 10-minute video taking the time to respond to you. They take the time to actually get on a video call with you and really get to know you versus the, hey, fill out this form, fill out this box, let's do a 3-minute phone call. Okay, good. How much money are you going to send and when are you going to send it?
Yeah, I do. And I totally, that's one of the aspects of syndication that I like is it's more one-on-one than with your stockbroker that works from 8 to 5. These guys are on call 24 hours a day to an extent where they're working these syndications, working these apartment building complexes, managing them if it's a vertically integrated organization, or working the contractor that they have managing it for them, how much they interact with them. Is it on a weekly basis, a monthly basis, a quarterly basis? How are they going to manage those contractors that they have working on this facility that I invested in?
Speaking of communication, I don't know if I'm jumping the gun here or not, but how often do most of your groups communicate with you, and how often do you like to be communicated with about the progress in terms of what's going on? I'm pretty sure nobody wants a phone call every day, otherwise you'd be doing it yourself, right?
There you go. And that's exactly it. It depends on what you sign up for. I have one syndicator that I get a monthly distribution from. I get monthly updates on my properties from them on a monthly basis, telling me, in fact, this one syndicator gives me more information than I want. They give me the rent rolls. They tell me what they spent money on. They told me where they made money, where they lost money. I mean, just into so much detail that I don't have time to go into it, and I don't want to go into it. I hired them to do that for me. I appreciate them being, transparent with me, but I really don't want that. I also have syndicators that I get a quarterly statement from, and I get a paragraph or two write-up that, hey, we're hitting on all 8 cylinders here. We had a problem here. It didn't affect distributions, or it did affect distributions. And we expect it to be resolved, and we're doing this to resolve it. That's what I really like, because I got into this business to be a passive investor. Like you said, I don't want to work it every day. Quarterly is fine with me. I like quarterly statements that tell me, although I do like the monthly dividend check or distribution checks, I still like the quarterly distribution checks, and a 1-page write-up or a half-page write-up telling me where we met plan, where we didn't meet plan, any problems, and what we're doing to resolve them if we do have problems. Or in most cases, we're ahead of plan. I got to tell you that most of my syndications right now are ahead of plan. Things have worked out better.
Yeah, that's good. Good.
Yep. But that's one of the things, you have to have a syndicator that you can talk to, because you want somebody to be upfront and honest with you and tell you, hey, we underestimated this on our due diligence, or we didn't find this on our due diligence, and now we got to pay for it out of your pocket. And they got to tell you, they got to be willing to tell you that, and you got to be willing to accept it. Yeah. Those type of things happen in this, and you either love it or hate it. I really like it, because I know I have a syndicator in all cases, as far as I'm concerned currently, that work to resolve those issues and work to make up for that lost money and put the effort in for it. So I do that. One of the ways that I also do that is I only will invest with syndicators that have skin in the game, where they're putting lots of money into the investment themselves, so that if they lose money, they're just not losing wages for a month or a week or a quarter. They're losing money out of their back pocket also. So that's one of the hurdles that I put on syndicators to make sure that I'm willing to invest with them.
Yeah, and some of those expenses and some things that happen can truly be a surprise. But there's other ones. I know I had an email one time from one group that said something about they basically missed the punch on property taxes. And I'm kind of like shaking my head like, how the hell do you screw that up? Like, you know what you're purchasing the property for. You should be able to do your research on that. Like, that's a pretty big fumble in my opinion. But then there's other things that, you know, like you said, that might be unforeseen or unexpected, or things that just happen, and you don't necessarily always have control over certain external factors. So it just depends on what it is. But I think the most important thing, that, as you said, is the fact that they're willing to communicate that to you, that they're transparent, and most importantly, what are we doing about it, right?
Yep. Yeah, I had one syndication that had a third-story swimming pool spring a leak in it 6 months after we purchased it. It cost us close to $100,000 to repair that leak in that swimming pool. Now, I got notified of it right away, okay? Hey, we had an incident here. We had this problem. It's cost this much. This is what we're doing. We went back after the original seller. We figured it was a hidden defect, and they should have known about it. And they're currently litigating that issue. But those things do happen. And I'll tell you my gut feeling, we won't win. We won't get any of that. We're going to have to eat that and figure out a way to make it up. And I've told my syndicator that.
Yeah. Well, at least they're trying, right?
Yep.
I mean, that's good that they're going to bat and not just saying, well, we're going to hold your distributions for the next couple of quarters and, you know, we'll figure it out, right?
Yep.
Cool. All right. Well, looks like we got the waterfall coming up next. I know we talked about that quite a bit on the last show. Tell us about the waterfall. For those that maybe didn't listen to the last show, or even if they did and they're still scratching their head like, what in the world's a waterfall? Can you break that down?
I don't know if I can or not. Listen, just so everybody knows, I've only been doing this for 2 years. I've only been retired for about 3. So just so you understand, I got about 2 years experience here. But the waterfall, basically, that's one of your bread and butter. Syndicator is the first thing. You got a good syndicator, and he's telling you the truth, and he's telling you good forecast. You can take that to the bank. But the waterfall tells you where you fit into that and where that money comes from. It tells you your payout position, your percentage of the profits that you're going to get, and the syndication performance hurdles in most cases. Sometimes those don't always make it all the way into the waterfall, especially fees. Fees don't always show up in the waterfall the way you would like to see them, or where it's obvious to you. So the waterfall, you got to make sure you're going to get what you paid for, okay? And that you're going to get paid. Most waterfalls, the first on the list, the first thing that gets paid is, you know, debts that the LLC owes, you know, the operators of it, if you have a third party in there managing the facility for you. Debt service, taking care of any loans that you bought. Because remember, one of the things that this syndicator did for you, he went out and got loans, whether they're short-term, long-term, floating, fixed rate, or set rates or fixed rate. He went out and obtained this financing for you. So you're usually leveraged, you know, 20% down, 80% borrowed, 25% down, 75% borrowed. And we're talking $30 million, you know, or more or less. But these guys, they did that. So after all of those gets paid, the electric bills and the gas bills and all of that, then's where it gets interesting, and that's where you and the syndicator, you're interested in that waterfall. I've seen waterfalls where the syndicator and the limited partner gets paid 50-50 at that point, okay? Or I should say at the same time. The syndicator gets his, let's say it's a 70-30 split. 70% to the limited partner, 30% to the syndicator. Well, whenever the $100 profit comes out, I get $70, the syndicator gets $30. There's agreements like that out there. Do you want in on that? Well, I tend not to, but those agreements are out there, and they have the history and the investors that make it profitable for them. The ones that I've got into, normally I get the 70%. He holds off until he gets his or until I get my preferred return. And then it's called a tiered, where he starts earning money towards the end of the agreement, year 3, 4, 5, and I get my money, definitely 1, 2, and then I start sharing money with him, year 3, 4, 5, 6, 7, that type of thing.
So let me interrupt real quick, make sure I'm following you, and for the sake of the listeners too. So you're saying, and this can be structured in different ways, but it's possible that the pref comes in first, so whatever your preferred return is if you have one, you get that first, and then you get all your capital back in some cases, and then a 70-30 split? Is that what you're saying? Or are you saying that the 70-30 comes in before return of capital?
The 70-30 comes in before the return of capital, or can come in before the return of capital. Some syndications are structured such that the $100 that comes in off of operating expenses, after operating expenses, 70% goes to the investors towards their preferred, and 30% goes to the syndicator. Others, all 100% goes to the limited partner until the preferred is met, and then the operator gets to share a portion of that. Does that make it clear?
Yeah, I think so. I mean, these can be structured pretty much any way, any variation of what we've said, and probably some other ways that we have not even talked about yet as far as that goes. But I think the takeaway so far is the way that you like it done in your deals and the groups and syndicators that you work with is you want to get paid first. So you at least want your pref first before that, in this example, 70-30 split takes place. Is that fair?
That's exactly right. I like to be up front because I'm investing my money, and I want to get paid back. And that way, to me, that eliminates an element of risk in the overall syndication that I'm in. If I get paid first, it's just like second on any mortgage. You don't want to be the second mortgage holder. You want to be the first. And that's kind of the way this comes across, is you get in there first, and then the operator, which holds a carrot, in my opinion, in front of the operator to not only get you your money, but also work that syndication hard enough that he gets paid.
Right. And the other thing too, just for the benefit of the listeners here, we talked, and I know we'll talk about it here coming up at some point about fees, but we talked in the last episode about fees. Make no mistake about it, the syndicator is still absolutely getting paid in the form of a fee structure outside of this waterfall split. So depending on the group and whether or not they're an actual vertically integrated company versus a promoter versus, whatever they're doing, there's still going to be expenses associated. So there's still going to be an asset management fee more than likely. They may have taken also an acquisition fee when they bought the property. So there's other fee income that they might be receiving in addition to their split. So I guess what I'm trying to say to the listeners is don't feel bad for these guys and we seem like a bunch of greedy investors, because they're still getting paid up front, along the way, and on the back end, and most of the time no matter what happens. We're just talking about the waterfall. So even if O-Dawg's trying to get his preferred return before the 70-30 split in this example takes place, the syndicator is probably still making money in terms of fee income along the way, outside of that 30% that they would otherwise take once it gets to that point. So they're not it's not like they're not earning anything. It's not going to be nearly probably as much, but there's at least something, right? They can pretty much, we'll give them a prison tray. They can eat the food. It might not be good, might not be great, but it's edible and it'll keep you alive, right?
Well, under worst conditions, I hear what you're saying, but yes, they are structured not to lose money, but they make more money if they make my money first. And that's the point I was trying to make.
Agreed. Okay. Gotcha. Yeah, no, 100% agree with that. And a lot of times it's on the back end on these deals. So yeah. Okay.
Yeah. As you like to say, the rest are just dog shit as far as I'm concerned. I got to get paid first, and then they get paid.
Well, that's fair. I mean, that is fair. I could see that.
That's my investment strategy.
Get paid first. That's good.
That's right. Well, then it goes on to distributions and profit. Okay, and I got into distributions to make money. So that's the part. Like I said, I do a spreadsheet, and usually the syndicator does a spreadsheet that he shares with me, or some kind of sheet that shows me what money he's making, what money I'm making. Most of them like to definitely show me what money I'm making. They don't really like to show how much they're making. But I do a spreadsheet so that I know how much I'm getting and how much they're getting. And that's the biggest problem I run into whenever I work my spreadsheet is I get greedy. I look at all the money they're making and looking at the living that I'm making. They're making money and I'm making a living sometimes.
Well, if you listen to the last episode, you probably heard me say I was once told don't count other people's money, right?
That's exactly right. So that's what I was leading up to here. You got to set your expectations. What are you looking for? You signed on or you got interested whenever it said this is the IRR range that you're in. If you're looking to increase those IRR ranges, you shouldn't be looking at what the syndicator's doing other than for information. How healthy is he? We were just talking about it. Does he have cash coming in early enough that he's staying afloat, or did he sell me everything up front and he's not got nothing unless he hits a home run and he's going to go out of business or lose interest on me? I want to know that he's healthy, I'm healthy, but sometimes it gets hard for anybody to look at it and say, well, he's more than healthy if this comes to fruition. So you need to make sure that I set a low profit. I can tell you right now, I invest in syndications that make a lot more so far than what my goal is. My goal is 10% or better. All right. If I can get 10% on my money, I beat the S&P historicals, or I'm right there with them. So if I can get S&P, which I use syndications to help me balance my portfolio and get me not so much in stock markets and bond markets and all that. I'm looking for something that generates good income. It helps me balance my portfolio that is connected to the stock market, but also disconnected. It doesn't act one for one with the stock market. It can go its own ways, sometimes up and while the stock market's down, and sometimes down when the stock market's up. But it helps me put together a balanced portfolio. So
Gotcha. All right. Let's see.
Yeah, fees you were talking about earlier. That's something that a lot of the times you'll find in the distribution and profits, and need to know where they're at in that fee structure. Are they up front and ahead so that the syndicator's getting them early, or does he have some that tucked in behind and it's going to be a back door at the end of the project? You need to know that. Do your spreadsheet, see if your bottom line's still what you thought it was going to be. You definitely be clear with syndicators on whenever you're talking IRRs and all that. It's net fees, net everything. You're talking bottom line numbers, or you're not, and that's where a lot of people get confused. They think it's here and it's there. You need to know where it's at. It's in the paperwork that you're signing. Put it on your spreadsheet or figure it out. Get your lawyer or your accountant to tell you. But you need to know where those are at. That tells you whether you're going to make the total profit and how easy it's going to make it. Fees can make a difference on 1 or 2% of the amount of money that you're dealing with.
Yeah, I remember there was a group one time that they said, and it was a fund actually, they were raising money and they were placing money with other syndicators in a particular space, and they made a comment about, they were quoting past projects and talking about past performance, which we all know is not an indication of the future, but they mentioned something about, here was the IRR, and they said the words at the project level or at the property level. And what they were alluding to, but not specifically and explicitly stating, is the fact that the property and the actual syndicator may have achieved a particular IRR, but because these investors were going to be investing through this fund structure, the fund also has a split associated. So the investor's IRR is going to be a portion of the project level's IRR, the property level's IRR. And still, in most of those funds, you're getting the vast majority of that. But to your point, you're not necessarily getting 100%. So for example, if they said, hey, it was a 30% IRR at the property level, but you're in a fund that pays 80-20, then presumably you're getting 80% of the 30, which is still 24%, which is knocking it out of the park in my book. But you need to be aware of that. There's a big difference between those two numbers.
You bet. And where it really hurts you, and I haven't experienced this myself, but it's from what I've gleaned from it, it's whenever you see the next offering come out and they take credit for the project that you were on and they're claiming some number that you didn't get. So you got to understand how you get to that. Otherwise, you get awful mad as soon as you see that saying, bullshit, calling them up, I want my share.
100%. No, I agree with that. Yeah. I mean, you got to be careful and, you know, they can change, like I said, last episode, if you're looking at the PPM and the operating agreement and all these things to talk about how all this shit works, yes, it can be confusing, but they can literally change one or two words and change the meaning of a lot of different things. So you got to really go through with a fine tooth comb.
Yep.
All right.
Performance hurdles are also in the distribs and sometimes up in the waterfall, but the performance hurdles tell you what, when, and how much you're going to get and the syndicator entitled to. I'm in a couple different syndications. Actually, I'm in 5 syndications. But what you'll find is there's a tier 1, okay, whenever they make their tier 1, when you've made, like, I have one syndication that tier 1 is at 13%. Tier 1 on another one's at 15%. I got one that doesn't have a tier 1. Okay, we do a 70-30 all the way through. But tier 1 on this one project, and it's just one multifamily unit, it makes the tier 1 is at 13%, and the once we hit that percentage, or I make that return, then it kicks in another fund stream for the syndicator. The next tier rate for that is whenever I hit 50%, and that's where, again, whenever I make my 50%, the next stream turns on for the syndicator. So that's a 2-tiered. I got a 3-tiered in here that goes 15, 50, 50. So you've got to look at each one of them and determine how that makes you work.
So you're saying for those examples, like one of them is the tier 1 up to a 13% IRR. You're splitting 70-30 until you as the limited partner investor achieve a 13% IRR. And then after that, did you say it goes to 50-50 split at anything above 13 or 50-50 split anything above 15?
50-50 above 13.
Above 13.
He's in it for 50. Yeah.
Okay. Man, he's making a killing.
Hey, quit looking at his money.
I know it. I set you up for that. I was waiting for it. All right, cool. Keep going.
Yeah. So then you look at your cash-on-cash returns and you compare them. And like I say, I put a spreadsheet together where I can put all my funds there. I can see what my average is. Okay, this is where I'm targeting. If I want to move my target up, that I look at my next investment to move up, or if I'm in what I consider the sweet spot, I leave it there. But I look at the cash-on-cash returns for all the different years. I look at the quarterly distribution estimates that most fund providers supply you. This is how much we're going to pay you in distributions on a quarterly basis, and compare that. Because again, depending on how you ramp up, affects the bottom line on what you're going to make. And you can use his calculation, and I can tell you a lot of people do that because he's in it for that business, and he's no different than the broker, and they don't go check their broker's pocketbook. But I do, since this is a syndication, and I like to look at that to make sure I have numbers that are exactly like his or very close, or it gives me something to talk to my syndicator about until I understand the contract better. So then you go to the IRRs and you look at that. I've got one that makes 16%, 16.2, one at 13.1, one at 10%, one at 15, one at 18.7 on a 5-year IRR. Not bad money.
So those are all projected 5-year holds? Is that what you're saying?
Those are all projected. That's the projected. You'll find that most of these syndicators will give you a 3, a 5, a 7, and even a 10. I'm out to one syndication that I'm in where we own a hotel as part of a fund, and that hotel is being built from the ground up. It is a 10-year hold in that fund for that particular property. The other two are on 3 and 5-year holds, is what the syndicator is targeting for those two other properties.
Gotcha. Okay. All right. The hotel, that's interesting.
Well, and again, they put it in this mix because after we build it, okay, we're building this thing. after it gets running, it's going to be a cash cow for us, and they want to hold it 10 years, and then they think they can sell it because of its location for a boatload of money while we're making good money off of it. And they were very clear and upfront with me that, hey, we're going to build this thing. It's going to be a cash cow in 5 years. And after that, we've got 5 years of good profits. We can sell it at 10 if we think it's worth selling at that point. It may be worth keeping for longer, but our target is 10 years. We think we can own it for 10 years and sell it and still make a profit.
Yeah, and that's the thing with a lot of these too. They're all targeted holds, and most of the time the language in the documents is going to read such that it's at the ultimate discretion of the syndicator. Going back to the whole pilot example, you have no control over that plane once you're in.
That's true, but you either love it or you hate it.
Right.
I do not know real estate that well. I don't want to know real estate that well. But these guys are all professionals at it. They live, eat it, and breathe it 24/7, 365. So, I'm hiring a professional to know this stuff, or at least have a good idea of it. And if the hotel is better off being sold in 7 years, I need somebody smart enough to pull that trigger.
Absolutely. Yeah. Hey, just out of curiosity on that one, a lot of times with the ground up stuff, they don't have a pref, but you mentioned it's in a fund, so I would assume the other properties are either value add or somewhat stabilized. Can you talk, if you know, about the structure of that package? Like, where are they using other cash flowing properties to subsidize operating cash flow to you as the investors while they're building the hotel? Like, is there anything coming in on an ongoing basis while that's being built from the other properties in the fund?
Well, the initial fundraising, we put in enough that we were able to come up to secure the loan, interest-only loan, until it is profitable. So we borrowed enough, or we invested enough up front, the syndicator and the LPs. We've got enough that we put in extra to carry it on the interest-only loans until it is profitable, and then it goes. Each real estate property within that, of the three, to the best of my knowledge and to the best I can remember, is self-performing. In other words, I get this percent distribution from property A, this much from property B, and I don't get anything from property C.
Okay. So it's a blended model, which is good. So every property basically, quote unquote, pays for itself. The two that are more operational actually produce a positive cash flow. The hotel is pretty much just, I don't want to say break even, but you have enough to sustain it while it's being built. But I guess the point I'm making for the sake of the listeners is, like, you invest in a fund structure like that. This particular one has 3 different properties. You're still getting cash flow from the other 2 while you're building the third.
That's exactly right.
Gotcha. Okay. Cool.
Okay, and then you get down to equity multiples. Okay, that's one of the other big thing that I look at. Again, it's a shot in the dark. It's everybody's best estimate. But remember, you're dealing with professionals, and, barring COVID or interest rate anomalies or whatever's going on right now, these guys have had good history, the ones that I've invested with, of being able to target and hit these targets that they're going. You'll read a lot of stuff that says these guys don't hit their targets. They typically overestimate and underperform. I've done my best on due diligence. So far, knock on wood, mine have hit their targets. I have some that have stumbled and reduced distributions, but I know why, and I think it's coming back. It's not because they underestimated, it was because of unforeseen problems. So I'm quite happy with the funds that I have right now, as far as being open and honest with me and doing what they say they were going to do and performing the way they said they were hoping to perform.
Yeah, I mean, you almost always want to have a situation where you still maintain, or the syndicator and effectively the limited partners all still maintain control of the asset. You may have to suspend distribution, so your operating cash flow might dry up, or they might choose to not pay it out for a period of time. But if that allows you to hold on to the property and not lose it, in the case of what's been going on in the recent economic environment, then all the better. So just playing defense and being able to navigate difficult times is just as, if not more important, than performing well in good times.
You got it. Okay. Yep, that's exactly right. The last thing that I look at is the stress test. Okay, I look, and a lot of syndicators don't openly provide this. This is something that I go for. But that's, if this property doesn't rent at the 94 or 95 or the 97 or the 86%, standard rental, when do we break even? When do we start losing money? And that's something that I've had to go back on a couple of my investors and say, I want to stress test on this. I want to know what percent we start losing money of rental rates, of doors that are rented.
So your break-even occupancy, right?
Break-even occupancy.
Gotcha.
And I call it a stress test. A couple of the syndicators call it a stress test. But you need to know that so at a glance you can see if, hey, we're still making money, and oh wait, we thought we were only going to be at 94 and we're at 96, and break even's at 75. Oh baby.
Yep, that's good. Very good.
So that's kind of the things I look at in some of the investments that I'm in, and the distribution. Financing has been one thing that has just popped up. You know, a lot of these syndicators get floating refinancing. Some of them pay interest only for 3 to 5 years or 2 years or whatever, and then they got fixed rate financing following up. Some of them do fixed rate right up front. The more floating or non-fixed rate financing that you get, the more risk that's in your project. So I tend to try to work with syndicators that lean more towards fixed rate financing. I don't mind a little bit of upfront floating rates, but I like fixed rate financing because then I know what the bills are going to be, and I don't get an oh gotcha because interest rates just jumped up 10 points or whatever.
They can get pretty creative with the financing too. Like you could have a situation, to your point, where you end up with fixed financing, but you may have a period of IO or interest only in the beginning. And I think the reason a lot of these guys and gals do this is if they're doing a value add and they're going to reposition the property, they buy a piece of shit at a good price and they want to make it nice, raise the rents, and sell it for more later. That's pretty much the play. Well, while they're fixing it up and turning it around and renovating units and slowly bringing the rents up to market and those sorts of things, if they're paying interest only, then the debt service is much lower, which they're not going to have as much cash flow when they're doing all that work anyway. So that works out pretty well. And then as things ramp up and the property presumably starts performing well, all of a sudden cash flows go up. If that interest only falls off and now they're starting to pay the loan, let's say it's an amortizing loan, a fixed interest rate loan, then they have the cash flow at that point in time to support it. So you're saying, if I'm getting this right, you are okay with a little bit of interest only, but you prefer after that to be on a fixed loan in a lot of cases versus interest only, but it's on a variable or an adjustable rate loan once the financing kicks in. Is that?
That's correct.
Okay.
Yep.
Because they can structure IO interest only either way, right? Interest only with an ARM or interest only with a fixed, and you like the fixed.
I like the fixed because then I know that I trust the numbers more. To me, it takes out risk.
Yep.
It may cost more. I may not make as much profit, but I've lost risk, however you want to say it.
Yeah, risk-adjusted returns. I mean, I get that. You don't want it to spiral out of control with an environment, especially like we're in today, where rates are on the rise, and you got interest only just ended. Now you got an adjustable rate, and all of a sudden it starts ratcheting up on you, and the property's underperforming, and the next thing you know, you don't want to spiral out of control and lose all your money. You'd rather make a lower return and get your money back than not get your money back at all.
Yeah, and I'll tell you where I come from on that. Me and my wife's first house that we purchased, we bought it at 17% on a 15-year fixed note. 17%.
Wow.
I don't want to go there ever again.
Yep. No, I agree with that.
One of the other things, just changing gears here, one of the other things that I look at on the financing side is cash calls. Some syndications still keep them in there. They say their lawyers won't let them do it without it.
Bullshit.
Yeah, that's the way I look at it too. I call bullshit on that. I say, well, my lawyer won't let me sign up to one like that.
And you watch how fast it comes out. Yeah.
Well, some of them it won't, some of them it will. Okay, but all I'm saying is that language is out there. You got to be looking for it. Otherwise, you could be in for a cash call. I'm looking for, again, risk aversion. I don't want to get hit up later on for more money. This is a one and done for me. I want to have the reasonable assurance that I'm not going to hit up. It's not going to cost me more than what my initial investment is if it goes south.
And what you're talking about is when you say cash call or capital call is basically they say, oh shit, we underestimated. We need more money. They go back out to the investor pool that's in that deal and say, hey guys, we need everybody to kick in an extra 10 grand or 5 grand or whatever. And you're basically saying you want to protect yourself by looking at and reviewing documents and probably not agreeing to documents that pretty much say that that's a possibility. You want to eliminate that.
based on my investment strategy, I never agree to anything like that.
Okay. And just for the listeners too, there's one group in particular out there that, and I don't, technically their phrase is correct, but I don't like it when they use it because this is in a fund, and they say something to the effect of, so on and so forth. We're identifying properties, blah, 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 and we're going to call the capital in 3 weeks. And what they're meaning is we've identified properties that we're going to purchase and put into this fund, and we're not going to ask you, the limited partner investors that are not yet invested in this deal, for any money right now because we don't have a place for it. But as we get a little bit closer to closing, 3 weeks from now, we are going to call the capital. We are going to ask you to make your investment into the fund at that time because we actually have properties identified and ready to close at that time. So call the capital in that sense is different than a capital call the way we're talking about it. So there's a slight distinction there, but those are two very, very different things, and I just wanted to point that out for the listeners.
You bet. And I'll go one further. There's syndications out there that you put in all your money, and then over 3, 6, 9 months, they purchase the properties, but you've already invested in March and they don't finish purchasing until January, but they've had all your money that long. And then there's every time you purchase a property, they say, hey, give me more money. And they give you 2 weeks to get them the money. They space it out. So you only invest as you go along or as they acquire properties.
Yeah, you want to be really careful about that too with, especially if it has a preferred return that's going to accrue. Well, when does it accrue? And there's some of them that say if you send your money in and it sits there and we don't close on a property, it's basically sitting there not earning anything. And other ones will say, well, if you put your money in by this date and we close the property on, 2 weeks later, and it will start accruing as soon as we close on that particular property. So you want to be in communication with the syndicator and know the properties that are identified, when are they going to close, and if I send you money, when am I going to start earning a return? The last thing you want to do is part with your money into an investment like this that is generally illiquid, only to find out that your money is sitting for 3, 4, 5, 6 months, not deployed, not used, and not earning a preferred return. And there will usually be some language in the document. I think I read one not too long ago that said something about if we don't deploy capital within 90 days, on day 91, your funds will start to accrue the preferred return, even if we haven't closed. So you want to look out for that stuff in the docs.
Yeah. And then the last thing, one of the last things I wanted to tell you, I always got things to say, but one of the last things is you better have a good accountant, because I'm in, like I said, 5 funds, and my K1s that I receive are from 8 different states. A lot of my properties are in Florida. I've got a couple properties in Florida, a couple properties in Georgia. I've got a couple properties in Illinois, one in Maine, one in North Carolina, one in Rhode Island, one in Tennessee, 3 in Texas, and one in Virginia. You get a K1 from each one of those states. That will drive your accountant crazy if he isn't used to doing this type of work. And he'll probably charge you for software if he doesn't have it for those states, if he needs software to perform your taxes.
Yeah, no, that's definitely important. And I think we harped on that pretty hard on either the last show or the past couple of shows, but it's definitely worth mentioning again that this is not a do-it-yourself type of project. So the way that I like to look at it, when you're looking at different types of investments and specifically real estate types of investments, the way that when I'm looking at my tax team and when I'm paying them, I think about spreading that cost over all my different real estate related investments. So chances are if I wasn't investing in real estate, I may still be doing my own taxes. I've done them for many, many years. However, now that I am investing in real estate, I'm going to look at my single family rentals. I'm going to look at my agricultural stuff. I'm going to look at my syndication stuff, and I'm going to take that cost and spread it around so that it's not like, well, it's my single families only that are paying for this, or it's my syndications only that are paying for this. Whatever real estate types of investments that you may have, or anything that's somewhat complicated, that's one way to think about it. But I guess what I'm trying to say is, if you're going to invest in syndications like this, chances are you don't want to scrape together your last little bit of money, put it into one syndication, and plan to never invest in syndications again, especially if you're going to incur the expense of having a tax advisor and tax preparer that is familiar with these types of real estate investments and how to prepare those returns and advise you. Because to make it worth your while and to make it worth the expense of hiring some of these specialized professionals, you typically want to. And that's one way that I kind of psych myself into it and convince myself, well, I need to do more real estate investments because I'm paying a fortune. And if I'm going to pay a fortune, I want it to be worth it. So I need more investments. I need more cash flow. I need more. And that's one thing to be thinking about. If you're listening to this and you're thinking, man, I don't have any real estate related investments, is this something I want to get into? Make sure that it's something you're going to go full throttle and put your foot down on the gas if you're going to do it. right? So,
Yep.
all right.
Couldn't agree more. The last thing I wanted to say is the way I started this, because it takes significant capital to get into this, is I took a HELOC out on my house. And that's what I invested in these with. I looked at it, worked the numbers. I was able to get a low HELOC. I eventually refinanced it with my house to get rid of the HELOC. I got a 2.875 interest rate. I love it.
Boom.
Okay. Yeah. And I'll tell you right now, if all my dreams come true and if everything works at the bottom of the plan, I'm talking about the low end, I'm making 18% minus 2.375.
Yeah. So for the listeners, in case they're not familiar, can you describe what is a HELOC and what is a cash out refi? Can you go over those for the new people?
I can kind of do it. I don't even know if I know it myself, but a HELOC is a home equity loan. Okay, and you usually get those, used to, whenever I got this, I was able to get it at 3.25% interest rate. And I was looking at 3.25% interest rate. I gave basically a second mortgage on my home to the bank, took out a HELOC loan, and I paid a 3.25% interest only loan because these are 3 to 5 years. I took a HELOC out to 7 years on my house, interest only HELOC loan, and I was going to pay the principal back from the profits or from the equity that I invested. I'd just replace it, and then I would have the profits later on to reinvest. So that was the HELOC. Then I was paying 3.25%. I got this notice saying, "Hey, we'll do a cash out refinance on your house," which is where you combine your existing mortgage and your HELOC. They give you that, and they'll refinance it for you at a lower rate. And I took that option. I searched around. I did the mortgage dance with all the mortgage players. The lowest I got with the terms that I liked was 2.875, and I liked it a lot. So we done that. So like I said, I took that money that I invested in real estate contracts at 2.875, or I borrowed the money at 2.875. Hopefully I'm going to make around 18% interest on it or thereabouts. If I make 10%, I'm still going to be happy. So, but at 2.875, and I call it my infinite money loop. Okay. I'm planning on refinancing my house again or taking a HELOC out when interest rates suit me, and I'll reinvest it again. I just see it as a way to make money off of somebody else's money, and I like that philosophy.
And that's what they say, right? Opium, other people's money, that real estate's an opium related business, OPM, other people's money type of business. And so I think for a lot of people, and I talked about this, I think on the Power of Your Mortgage show way back, that it really is a paradigm shift for a lot of people. There was many, many years ago when I was of the mindset that everything was supposed to be debt-free, paid off, no debt, no way, no how. I was going to pay my house off early, all that shit. We talked about that in the show. And once you start to look at this stuff and you say, okay, what is the highest and best use of a dollar? And if I invest that, what can I get? And can I borrow for less elsewhere? And you're essentially creating what O-Dawg is describing, which is positive financial arbitrage. You're borrowing at a lower rate and you're investing at presumably a higher rate. And you still have to have a certain risk tolerance and risk capacity to do that. If you're the type of person that never invests money in the stock market, never invests money in real estate, put all your money in the bank at 0.0001%, and you want no risk, this is not for you. And by the way, quick disclaimer, because we haven't given it yet, we don't give any advice on the show other than, if you listen to the last show, get a home inspection. If you're buying a turnkey rental or any real estate related property, try a chicken bake at Costco, even though the price has gone up in a lot of locations. Other than that, we give no advice, no tax, legal, financial, any other advice on the show. Always consult with your own professional before making any decisions. So that's our disclaimer. But with that said, what he's describing is something that he's done. It's something that I have done, which may or may not be the right decision for you. So you really need to take a look at your own investor philosophy and psychology, and that's a whole separate show, but something to be thinking about. But yeah, just to recap on the home equity stuff. The HELOC, home equity line of credit, it is a revolving line of credit. It is typically at a variable rate, although some of them will have a fixed lock feature, and you can pretty much take out what you need up to the limit that you get, pay it back or not. He mentioned interest only. Most of them are going to be interest only for what's called the draw period, which usually they're all structured a little bit differently, but can be up to about 10 years or so. You don't have to use it for that long. And then after that, it kicks on and amortizes as a principal and interest payment as you pay it back. But what he did, sounds like he drew it out. It was interest only for the time period that he had it. Then he had a better offer to basically lock in a long-term fixed interest rate loan. And by the way of doing that, essentially this lender will force you, in most cases, to pay off the HELOC. And now you have a fixed rate loan, presumably, I think what'd you get, 30 years, right? Like that?
30 years at 2.875.
Yeah. So now the money's out, and no matter what rates do, as they've gone up recently, that rate's locked in for him, and he can take the cash and do what he wants. So the home equity line, the rates can typically run on you. It is a variable line of credit. The home equity loans or a cash out refinance, normally that's going to be more permanent financing, and generally that's going to be at a fixed long-term rate. So good job. That's good stuff. All right.
Hey, that's all I got.
Well, I had one more thing in the notes here on the outline. The why. I think the last page was the why. So why did you get into syndications, and any final comments that you want to talk about your map or any of that stuff?
Oh yeah, I can talk about that. The why I got into it is I enjoy looking at these proposals that the syndicators give me, looking at these apartment complexes and just getting a feel for the different areas around the country. I like that, thinking about it. I like looking at it, trying to make sure it makes sense to me. I may not be a real estate guru and definitely not a multifamily investment guru, but does it make sense? Does it look like it would be a place I would want to live? Does it, does the demographics of the area in Texas look like it's going to support it? All of these businesses that are going to be employing, these people have a lot of information that they share with you, or will share with you if you ask, that tells you why they think this is going to be a good investment. If they're buying it below market, what other properties are going for in the area. Those are all things I enjoy looking at. I don't know why, but I enjoy looking at it, and I like looking at. I like the leverage side of it. It's all, to me, really good. I get to, for a little bit of money, I'm able to get into a big project. I mean, the little bit amount of money that I put in compared against 55 million is a pittance. So I get in, I get the leverage. I get somebody to manage this for me, a big dollar. This is not normally, I'm sure there's fly-by-night organizations out there, but these are professionals that you're able to hire and manage your money for you that does very good. Like I said, I minimize risk. I look at the deals trying to minimize risk, minimize. So, there's nothing you can do that if a project goes south on you, that your initial capital investment, you can lose it. You got to be able to and willing to own that. But there's no additional risk to it. I'm not liable in most of these limited partners that I've looked at as a limited partner. I'm not liable for any of the loans. If the syndicator goes under, I'm not liable for that loan. Or if my apartment complex goes under, the general partners are liable for it. I have very limited risk, and I like that. What he was talking about on my map, I think it's 15 properties total that I'm invested in. I've got a map of the United States, and I've got every one of them marked on my map. And every time I get a new one, I gleefully add it to my map. But I like looking at all these flags on my map and all of these hotels and multifamily places that I own, showing me where they're at across the country in all those different states that I talked about. Some of them in the same cities, but I'm diversified across the United States. Like I said, I think the only one I have more than 3 properties in is Texas. Everything else is 1s and 2s, and they're usually in Fort Lauderdale, Florida, or Miami. I'm a city difference on most of them. So I get to look at that, and it just is a good feeling for me to look at that every now and then. And like he said before, I look at it, and if I make 10% versus 0.01 at my bank in the savings, I'm tickled to death. I can get 1.5% at one of the banks. Again, that's what I can get. So if I can get my 10%, great. I'll be tickled to death. If I get my 18%, I'll be ecstatic.
Right. Well, and obviously probably goes without saying for the listener, but it is a completely different risk profile. Like your bank, you're not going to earn the return, but you're pretty much guaranteed to lose to inflation. At least with this, most people would agree that real estate is an inflation hedge among the other benefits. So yeah, you can hopefully make a much better return. You had a piece in here on the notes about note funds. Do you want to say anything about note funds?
I'm involved in one fund that is distressed mortgages. It plays a flat rate to me, 10% a month of the money I have invested in it. Again, it was a 3 to 5 year investment. It looks like because of housing prices, they may close that fund early. Jury's still out on that. I'm not sure exactly where I stand there, but I get a steady distribution every month of 10% from distressed mortgages. This is a
10% annualized, though, right? You're getting paid
Yep.
monthly, but it's the equivalent of 10% a year. Is that what you're saying?
That's correct.
Okay, gotcha.
Yeah. But these guys, this company that I'm involved in, are buying the distressed mortgages. They're trying to help the families that own them, that are in distress. They refinance. They do a bunch of work trying to help these families keep their home. And that's how success is defined in this company, is on the percentage of homes they're able to keep with the people that were losing them. I think that's a good cause, in my book anyway, and I get to make 10% by loaning them my money. So again, that's the distressed mortgage limited liability company that I'm in. I think it's a worthy cause. It makes me money, helps people stay in their homes that they worked and got into and got into a bad way, and now they're trying to help them get out of it.
Good deal. Do you have any final comments for the listeners?
No, all I can tell you is I think syndication is great. It's changing. I don't think it's a very old. At one time, I could have told you how long we've been doing syndications out there. I've only been in it for a couple years, but there's been people in it since day one. It's made a lot of people money. A lot of people went broke. Make sure you know what you're getting into. But I think all in all, it's a good way to diversify your portfolio, especially if you're a 401k guy like me. I worked for all those years. I only had a 401k. I was in stocks and I was in bonds. I needed something else. So that got me over into the real estate. I've been pumping that up, trying to get my little pie a little bit bigger, and I like that very much.
So the most important question of the episode: when the hotel is completed, are you guys going to accept Chase Ultimate Rewards points?
I don't know. I have no idea. Right. But hey, this is one thing I will pass along to other people. If you want to know how your properties are performing, get on the web, look. The people that are renting your apartments through these LLCs, there's normally a page out there, a Facebook page, there's something out there where you hear them discussing whether they like the apartments or they don't like. Do that same thing on syndicators. That's one of the things I did to look at syndicators. What's their history? What do their tenants think of them on the properties that they're already managing? Do I want to go with them? Then I look at those. All of that information's out there to help you make a decent judgment on the syndicator. There's some of the postings that are just off the wall, you discount them, but some of them are legit. It depends on how many are legit, what they're doing, and what that the operator's doing to fix those problems.
But that's a good point. But also for the listener, just make sure that especially if you're looking up the property, like if you're looking at reviews at the property level, look at the timing of those reviews. So like O-Dawg could have the best syndicator and company that he's working with in the world, and they could turn it around, do a really good job, put in a dog park, swimming pool, whatever. But if those reviews are from when the property was mismanaged before it was purchased by the syndicator, you want to make sure that you're attributing those potentially negative reviews to the right source, right?
Correct. Yep.
Okay. All right. Well, I think that wraps up on our side. Thank you again to O-Dawg for coming on the show. Thank you to the listeners for listening to the show. I know this was kind of a long one. Don't forget, if you're the first one to email the show and you want us to send you a link to purchase, and it's not our book, we're just trying to get a 50 cents for doing this show with one of those Amazon Associates affiliate links. Doesn't cost you any more. Email the show, realtalkpersonalfinance@gmail.com. You can put the title or the word book in the subject line. We'll send you that link to pick up the book on syndications that we both found very, very helpful. If you're the first one to do that, you can also put in the subject line whether you want an e-gift card. I think I can do an e-gift card to Costco to get you a chicken bake, or if you'd rather some pizza, we'll get you an e-gift card to a pizza place of your choice. That is all we have. If you feel like we've earned it, 5-star rating and review is always welcome. Q&A, send them to the same mailbox, realtalkpersonalfinance@gmail.com. Thanks again for checking out the show. Thanks again to O-Dawg. We will see you in the next episode.
Check the mic and make sure it sound right, boys.